While the retail market celebrated cool inflation data and a surge in bank earnings today, institutional capital is keenly watching a subtle yet critical divergence. The S&P 500 and Nasdaq ended higher, propelled by robust financial results from giants like JP Morgan and Goldman Sachs. Yet, beneath the surface, a bellwether like IBM issued weak revenue guidance, raising questions about the true breadth of this recovery. This isn't just about headlines, it's about the underlying structural shifts defining market leadership. The market's performance today underscores a crucial structural dynamic: asset insulation. Financial institutions, particularly major banks, possess robust business moats. Their diversified revenue streams, extensive client bases, and regulatory protected capital structures offer a degree of resilience even in volatile environments. This core value proposition allows them to weather economic shifts, often benefiting from interest rate movements or strong capital markets activity. Conversely, the technology sector, while broadly benefiting from structural momentum like AI, isn't a monolith. The Nasdaq's outperformance, driven by chip gains, points to specific growth segments. But older, more diversified tech players like IBM face different competitive landscapes. Their value proposition often lies in enterprise solutions and legacy infrastructure, which can be slower to adapt to rapid technological shifts or economic cycles. Now, let's unpack the cool inflation data and solid bank earnings. Lower inflation readings reduce the pressure for aggressive rate hikes, a significant policy tailwind for risk assets. For banks like JP Morgan and Goldman Sachs, this environment, coupled with ongoing economic activity, likely translated into robust net interest margins and strong investment banking fees. The market appears to be pricing in continued liquidity growth. That's not the only signal. The Nasdaq's surge, fueled by chip gains, suggests institutional capital sees clear earnings visibility in advanced technology sectors. This contrasts sharply with the broader revenue metrics for a company like IBM, which faces a more mature market. The focus here is on margin expansion potential, which is highly divergent across these distinct industry segments. Here's where things get interesting. Despite the broad market optimism, IBM's management issued weak revenue guidance. This isn't just a quarterly blip, it reflects a strategic execution challenge. It suggests that even with a macro tailwind, certain companies face company-specific headwinds in transforming their business models or competing in rapidly evolving markets. This impacts capital allocation decisions and future growth vectors. This matters because management commentary often provides the earliest signal of fundamental shifts. While JP Morgan and Goldman Sachs likely spoke to continued demand recovery and strong market activity, IBM's outlook suggests a slower pace for enterprise spending in their specific segments, or tougher competition for market share. Institutional investors pay close attention to these contrasting narratives to reposition capital effectively. Now look at how the broader sector is reacting. The macro environment, with cooling inflation, offers a favorable backdrop, particularly for growth-oriented tech and companies sensitive to interest rates. The competitive landscape for chipmakers and AI innovators is intense but expanding, leading to strong demand. Financials, meanwhile, navigate a regulatory-heavy but potentially higher-yield environment. However, the escalating Middle East tensions introduce a geopolitical dimension. While not directly impacting today's earnings for banks or tech guidance for IBM, these tensions represent systemic headwinds. They can fuel energy price volatility, disrupt supply chains, and create broader market uncertainty. This factors into institutional risk pricing, regardless of daily inflation prints. That leads us to a bigger question regarding terminal risk. For banks, vulnerabilities include potential credit tightening or a sharper-than-expected economic slowdown, despite current resilience. For tech, beyond IBM's specific challenges, the broader risk is a potential overvaluation in certain AI segments, or a regulatory pushback that could impact future growth trajectories. Specific to IBM, weak revenue guidance highlights pressure points in legacy enterprise services, where cost inflation or intensified competition might be squeezing margins. Regulatory pressures in data privacy or antitrust could also become more pronounced for large tech companies, affecting their long-term growth narratives. These are the nuances institutional investors must assess. Looking ahead, Forward earnings visibility remains strong for key parts of the tech sector driving the Nasdaq. However, a valuation reassessment might be due for companies like IBM if their turnaround strategies don't gain traction, or if their core segments continue to face secular headwinds. The multi-year thesis for market leadership will likely hinge on companies demonstrating genuine margin expansion and innovative market penetration. The market is currently undergoing a capital rotation, favoring growth where earnings are visible, but also appreciating the resilience of foundational sectors like financials. We anticipate continued yield pressure and policy tailwinds to shape this environment. The next signals will come from upcoming corporate guidance and how effectively management teams articulate their strategy in a bifurcated market. So, where does this leave us tactically? The chip gains and overall Nasdaq strength suggest a breakout watch for companies directly benefiting from structural tailwinds in AI and advanced computing. The strong bank earnings, particularly from JP Morgan and Goldman Sachs, indicate a resilient financial sector that continues to offer relative strength. However, the weak revenue guidance from IBM merits trim consideration if its specific challenges aren't quickly addressed by management, signaling a need for careful segment analysis within tech. The takeaway for sophisticated investors is clear: today's market action wasn't just about good news, but about the nuanced structural shifts beneath the surface. Understanding where institutional capital is flowing requires deep analysis beyond the headlines. For more intensive investment theses and unvarnished market intelligence, make sure you're subscribed to SRMoneyNews. Click that subscribe button, hit the notification bell, and join our community of institutional thinkers. We'll be back soon with more insights to help you navigate these complex markets.